Welcome. Today we are looking at a very famous standard, and this standard, this standard is called Ifrs 3. Ifrs 3. IFRS 3. It's a very, very famous standard indeed. And just like any other standard, I want to mention that please, when you're dealing with standards, any standards in financial reporting, use the Lusambo formula. So the Lusambo formula should be used. Use the Lusambo formula to understand any standard, and this formula is equal to ARM. ARM. Those who've been who are doing financial reporting and advanced financial reporting with us, they understand what this means. The A represents the about. The R there represents the recognition criteria. You must know for any standard recognition criteria. And then the M represents the measurement. Now that's the accounting treatment. So those who are studying with us, they know what those things mean. So let's say if we start with the A, the about. What is this standard IFRS 3 about? Okay, let me even write it properly so that we clearly mention what the standard is about. Yes, this standard IFRS 3 is about this beautiful young lady called Goodwill. Goodwill, yes. That's what this standard is about. Now, Ifrs 3 gives us the treatment of this beautiful standard, of this young lady called Goodwill. Now, I want to split this standard, this Goodwill into 3 as the IS 3 requirement. So Goodwill is in 3 parts. The first one is called inherent goodwill. Inherent. So there's what is called inherent goodwill, and then there is what is called negative goodwill, and then there is what is called purchased goodwill. Now, purchased goodwill is very, very examinable. Purchased goodwill is examinable. You must make sure that before exam day you understand what purchased goodwill is, because this one, let me even include it here to say it is very, very examinable. Okay, let's do that. Let's do that. Okay, so let's go back, and we're gonna pick the same color. Let's say purchased. So purchased goodwill is examinable. Okay, so you can even say examinable here to show that it is very, very important. So this one is highly examinable. Okay, now I want to quickly give you an example that I believe is going to help you understand goodwill really, what goodwill is. Okay, so let's go. We have inherent there goodwill, we've got negative goodwill, and we've got purchased goodwill. So I have this example for you here to help you understand goodwill. Let's say we're talking about 2 individuals. One of them is called Mapesa POC, and then the other one is Lusambo POC. Okay, so this lady here, Mapesa, owns a farm. So let's give some life to this story. Let's say if this is a farm, then obviously you know there are some farmhouses there. Yes, there are some farmhouses because it's a farm. Yes, there are some farmhouses. Yes, so we've got some beautiful, beautiful farmhouses right there. Okay, so we've got some farmhouses there. Yes. So we have lots of farmhouses at this farm. Yeah. Yes, we have some farmhouses. So we give this farm some life. Then apart from that, this lady has built a mansion on a farm. So she has a mansion right on a farm. Okay, she has built this big mansion on a farm. Okay, she has built this beautiful mansion on a farm. That's where she lives. Okay, and that's the door right there. Okay, let's say that's the window, and then that's the door. Okay, that's the door right there, and this is another small window. So basically this is a farm, and she lives in this house. Now stay with me. This example is going to make a lot of sense in understanding inherent goodwill, negative goodwill, and purchased goodwill. Okay, now just next to a house, Mapesa has a water tank. You see, she has a water tank because there's a borehole at this farm. So she has a water tank. Yes, that's the water tank right there. Okay, so that's a tank. That's a tank at the farm. She has a water tank. Now, this means that there is a borehole at this farm. So the borehole supplies water to this tank. Okay, apart from these things, at this farm, let's say there are also some beautiful trees at this farm. Yes, there are some beautiful trees at this farm. There are some beautiful trees at this farm. Yes. So there are some beautiful trees right there at this farm. Of course, there are some beautiful trees at this farm. So all we are doing here, we are giving life to our story. I want you to come and appreciate what we mean when we say inherent goodwill, negative goodwill, and purchased goodwill. So we've got lots of beautiful trees at this farm. Yes, we've got trees at this farm, and the farm just looks beautiful. This is such a beautiful farm. There we have a beautiful farm. There are trees everywhere at this farm, so we've got beautiful farm there. Okay, some greener grasses there, providing some good. Now, just near this farm, we have something of value here. There's a stream that passes just near this farm. You see? So there is a stream here. There's a river just near this farm. You see? There is a stream here just near this farm. So that's our stream there. We've got a stream. Yeah, water. So water is available just here. Now, just after the stream, we have beautiful mountains just at this farm. You see? So there has been some beautiful mountains. Now, these mountains, they provide such a wonderful view for this farm. It really looks very good. And to even make it better, there's a busy road just near this farm. There is this beautiful road. So there's that busy road there near the farm. And this road is a very busy road just near the farm. So please stay with me. We are talking about goodwill. So I want to show you what inherent goodwill is, what purchased goodwill is, and what negative goodwill is. You see? Now, as if that is not enough, at this farm, there are also employees who work at this farm. Got this lady here, she's a cook at the farm. Got this other lady here who works at the same farm as an assistant. Then we've got this gentleman here. This gentleman who is a farm manager, very experienced farm manager. We've got this other gentleman here who does some serious work at the farm. So these employees are all very experienced employees. They all work at the farm. They make sure the farm looks good and everything. So it's such a wonderful team there is at this farm. Okay, anything else that we have at this farm? Yes, we have something at this farm. Now, I want to show you this in this way. Just between this river here and the road, we have some plain. This is a plain. Now, when I say plain, I mean a place where cattle can come and graze here. So we've got some cattle, yeah, some cattle grazing at this farm. We've got some cattle grazing at this farm. Yes. not one of those beautiful drawings, but they're just there to illustrate the point. Yes, so we've got some cattle at this farm. Yes, not necessarily. Okay, there we go. Yes, so we've got some cattle. They're able to graze here nicely at this farm. So it's such a beautiful farm. There's a busy road here, so let's even give them names. We've got a road here, so this is a road. And then here, what we have here is a stream. So we have a stream there. We have a stream there. Yes, things are nice at this farm. So, what is inherent goodwill then? Inherent goodwill, it is the kind of goodwill that you cannot recognize. And the reason is simple. The reason why inherent goodwill cannot be recognized because you cannot attach some value to it. So if you look at this farm here, what item do you think you cannot attach some value here? Let me point out to you something here. Look at this road. This road is a good example of what you can't attach some value to. Road, one, you can't attach some value to that road. Okay, how about the plain here, where the cattle are grazing? How about the plain? Can you attach some value to the plain? No. So this one is also something that you can't attach some value. Okay, look at the stream. We have a stream here. This stream is another thing that you can't attach some value because you did not pay any money for this stream. You did not buy the stream, you just found it there. The road, you're not the one who constructed. It just happened that you bought a farm at a beautiful location and there's a road nearby. Look at the mountain there. The mountain there is another item you cannot attach some value. You see, because it's just already there. So these things you cannot attach value to, but they make your farm beautiful is what we're referring to as inherent goodwill. So this is what we're referring to as inherent goodwill. Now, the accounting treatment of inherent goodwill is that it must not be recognized as an asset. And the reason is simple because there is no value that can be attached to these things. So if my PURCHASED woke up and said it to say, no, because I have this and this, so my goodwill is so much, no. The standards say my PURCHASED can't recognize this stream, the road, the mountain, and the plain as goodwill because she can't attach some value to this item that are at a farm. That's number one. That's number one. Stay with me. Let's go to number two. Number two, we are going to go to the examinable one, the purchased goodwill. This guy here. So what is purchased goodwill? This is where this handsome man here comes in, Lusambo PLC. So Lusambo PLC has got some interest in Mapesa PLC's farm. And Lusambo PLC is proposing to Mapesa PLC to buy the farm. So what does Mapesa PLC do? She tells him to wait so she can come up with the value of the assets that she has at her farm. So she counts, number one, she has a borehole. Number two, she has a big mansion here. Number three, she's got these smaller houses for employees at the farm. So she's got all these assets at the farm. Then number four, she also has some cattle at the farm, which possibly she wants to sell. So she counts the value of all these assets. And she finds that actually these assets are worth 100 million. Okay? She says this asset plus what she used to buy the land and the farm and everything, she comes up with a total and says total assets. The total value of this farm is 100 million. Okay. So she has come up with the value there, 100 million. Okay, that is beautiful. Now, she calls Lusambo here and she tells him that she's willing to sell the farm to him at how much? At 200 million. You see? So let me just say 200 million. So she wants to sell at 200 million. Are you seeing? But what is the value of our assets at that farm? Everything that can have value assigned to them. They are worth how much? They are only worth 100 million. So when you get the difference here between 100 million and 200 million, you find that Mapesa PLC has made an extra income of how much? of 100 million. You can go at profit. But in accounting terms, this difference here is what we are calling goodwill. Goodwill. That is this guy right there, goodwill. The difference between the value of the assets, these assets at the farm, and what actually Lusambo PLC has paid is what we are referring to as the goodwill. So in Ifrs it defines this goodwill as future economic benefits arising from assets that are not capable of being individually identified and separately recognized. So which assets in this farm that cannot easily be identified and individually measured, maybe if I may put it that way. Now, you may be wondering, but Mapesa PLC has made so much money. The assets are only worth 100, and then she sells them twice the price. Why? The reason is because she has experienced employees. One, are you seeing that? She has a beautiful location. See the location where her farm is. The location is number 2 because the location is good. There's a plane, there's a tarmac nearby. You see, they're all such kind of thing. There's a stream and things like that. All these things, put them together. Individually, they can't be separately identified or separately recognized. But put them together, they are adding a lot of value to this farm. So it is because of these beautiful things that are at the farm. Experienced employees, she's got the beautiful location, near to the mountain, near to the road, the busy road. So that means you can easily transport your goods and services if you are a manufacturing company, you want to come and start operating from this farm. So because of all these beautiful things on the farm, Mapesa PLC has decided to charge a price higher than what the farm actually costs. So this difference here is what we are calling goodwill. And we've given the examples of experienced employees, the beautiful location of the farm, etc. That is our goodwill. So the accounting treatment of goodwill is that this goodwill acquired in a business combination is recognized as an asset and initially measured at cost. That's the accounting treatment of goodwill. So that means goodwill now must be able to be recognized at cost. So the accounting treatment is that this guy you recognize at how much? At cost. So goodwill must initially be recognized at cost. Now after that, if today, let's say Mapesa PLC sold this farm today at the 7th of May, and then next year at the 7th of May, it will be more than a year. It will be exactly 1 year. At the 18th of May, she will have to report. Somebody else has got to report here. What's going to happen that this goodwill, we need to assess it to see whether it has been impaired. So the standard Ifrs 3 says that goodwill must not be depreciated. However, it is not amortized at per se. However, it must be reviewed for impairment in accordance with the IAS 36. So review this goodwill every year for impairment. Review in accordance with IAS 38 to see if it has been impaired or not. That's how you deal with this goodwill. Now, let me show you how you review goodwill for impairment. There we go. Let's say we are in a group accounts question and we have these things. We have the net asset list here. This is what I think I just love this example. We have the net asset acquisition. At acquisition there. Then we've got at reports. And I love bringing in what we call PAP, the post-acquisition profit. So let's go. What we usually have here, we have things such as the share capital, We have the share capital. We have the share premium. And then we have the retained earnings. And then we have a fair value adjustment. We have URP. No. Let me bring in depreciation before URP to look more professional. Okay, then we have the excess depreciation there, and then we've got our URP. Okay, so if you say share capital was 90,000, let's say 90 million, and then at report also we have 90 million. Share premium we had 20. Here also we have 20. Retained earnings we opened with 30. We closed with 70. And then fair value adjustment, what do we have? Yes, at acquisition there was an adjustment. We had 10. At report, what did we have? At report, let's say 10 comes here. Then the excess dip, we've got 4. Now, we don't put depreciation here at the start because we're just getting you depreciate at the end. We've got 4 there. URP, we don't transact when you're acquiring. At the end, you've got, let's say, 7 there. Okay. So here's what I want you to see. What happens is this. If you add all these figures here, you're going to have something 90 plus 20, that is 90 plus 10. We have 100 there. 90 plus 10, that's 100. Then we've got 150. So let's say your net asset listed acquisition, they are now 150,000. Okay. This figure here, you're going to use it to work out your goodwill. So now let's go to your goodwill and see what we mean by goodwill impairment. So here's the thing. So if this is our goodwill calculation, what we actually have here is that we have the purchase price. You see, we have the purchase price here. Okay, we have the purchase price. Let's say purchase price was 200,000, 200 million. Okay, and then we have the NCI at acquisition. Let's say the NCI at acquisition was, let's say it was just maybe 50 million. When we add the two, we have the 250 million. Okay, now look at it this way. We bring the net asset list at acquisition, this 150 million, we bring it here. Bam, we less from the goodwill. So what, from the total value, then we are going to have something here. Now the figure we are going to have here is what we are calling goodwill at acquisition of 100. So we have 100 goodwill at acquisition. Now when we say goodwill must not be depreciated but reviewed for impairment. So what do we do? We say see high percentage, the company that acquired another company, you check the percentage, see high percentage of what? Percentage of goodwill. Remember this figure here, the 100 is what we are calling the goodwill at acquisition. Now, if we check the impairment loss, we have to check the impairment loss. Was this goodwill impaired? If the goodwill was impaired in any way, we then come and remove the impairment here to show, let's say it was impaired by 20. So we remove the 20 to come and have goodwill at report of 80 million. So this is our goodwill at report. That means you've reviewed goodwill in accordance to IFRS 6 to see if it was impaired, if it was impaired, so that you can have the true value of goodwill. Now let's see why did they bring the net asset list here? I wanted to show you something. The reason why we are trying to come up with an asset list here is to show the true value of goodwill. So what happens is this: if one of these assets, let's say the fair value adjustment at the beginning of the year was 10, and then at the end of the year, it becomes 20. You know what this means? It means that the asset, when the asset value goes up, goodwill goes down. Meaning that goodwill is going to go down by the value of the increase in the asset value. That means this total here is going to increase by 10. So the number we are going to remove here is not going to be 150, it's going to be 160. Are you seeing? It's going to be 160, meaning that the goodwill is going to change from 100 to 90. It's going to change from 100 to 90. So you must be able to see how goodwill changes when assets increase. So when you're doing the net asset list, the reason why, if there's, for example, an asset that was not recognized at first, later on came through in the questions, you have to bring it here. All those brands, bring them here. If there was a brand that was acquired and ABCD, just bring it here. The reason why you are bringing that brand here is because you want to reflect the true value of this guy called goodwill. The more assets gain value, the less goodwill has value. The more goodwill loses value. So goodwill cannot be the same year in and year out. The reason is simple, because goodwill does not change. Remember when Mapesa PLC, under this cell, the goodwill was 100. Goodwill remains fixed. Are you seeing? It remains fixed. Whenever assets gain value, goodwill is not gaining value. You're simply reducing those that have gained value from this figure. And this figure is going what? Is going down. That is what we mean when we say goodwill has been impaired or goodwill has not been impaired. Purchase goodwill. That's what happens in financial reporting. So be able to know. Do not leave assets that can affect that were there at acquisition on the necessary at acquisition, because those are going to show you the true value of goodwill. If you leave, say, an asset was there but was not included, but you know it was included, then you don't know how to treat it. You leave it here. It means your goodwill working is going to be wrong. This working is very important. It's going to be wrong because you're not going to show the true value of what this company actually, the amount of goodwill they have. Now, let me take it to another scenario. Let's go back to negative goodwill. What is this negative goodwill? Well, negative goodwill may arise in the following situation. Let's say this time around Mapesa PLC, after counting that these assets are worth how much? They are worth 100. Let me even say for this guy. Let's say now Mapesa PLC says her assets here, after counting them, they are worth 100, yes? But what does she do? She tells Lusambo PLC to just give her 90,000. You see? Lusambo PLC pays 90 million. Have you seen? The true value was 100 million. But she sells at how much? At 90 million. That means there is a difference here of how much? Of 10 million. She has lost. Have you seen? Because she has lost, this difference here is what we are calling negative goodwill, which some people also immediately recognize in their statement of profit or loss as just again on acquisition or other income. But for Mapesa PLC, they have done what? They have lost. You see? That is negative goodwill. So if you're able to go to the textbook's definition, they say, Ifrs 3 refers to negative goodwill as the excess of acquirer's interest in the net fair value of acquired and paper asset. Did you understand that? I didn't even understand that anymore. But this example gives it more light. So you're able to see the negative goodwill. This one, the assets true value how much? Assets true value 100, but Mapesa PLC sells to Lusambo PLC at 90. That means there is a reduction in good. There is a negative goodwill. And negative goodwill, the accounting treatment that should be experienced immediately to profit or loss, should be taken treatment to profit or loss. However, Lusambo PLC should not be so excited when there's a negative issue of negative goodwill. Why? Lusambo PLC should be able to sit down. When there's negative goodwill, you should not be too excited. What if there were some errors? You feel you've bought at a lower price when actually the person who is valuing the assets made a mistake. So before you can actually begin to confirm things, please be able to check for errors. Check if there were any errors, if there are some assets which have been impaired, you just don't know. Check for those things before you can start celebrating that you have some goodwill or not. So really, it is such a beautiful, beautiful standard that if you understand, is going to be able to help you understand group accounts very, 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 very well. I thought this standard was beautiful for me to share, goodwill, so that maybe as you go through group accounts, you go through the net asset list and then the impairment and things like that, you should be able to see the importance of goodwill. So remember the arm. The arm always is in play. The A, what the standard is about. The R, the recognition criteria. And then the M, the accounting treatment, which is simply the measurement. And we've said that goodwill, inherent goodwill, must not be recognized as an asset because there is no value that can be attached to it. As we saw in the example of this firm here, there's no value that you can attach to a specific employee or to a stream that passes through this this farm, or to a road, or to this mountain. What else did we say? The negative goodwill happens when the company is acquired at a price lower than the carrying value of the net assets or assets put them together. Purchased goodwill, that is examinable, and that one must be recognized if it is acquired in a business combination. It is important to remember that. So this was Shadrach Lusambo. If you want more of these, please feel free to call. Feel free to call us. Call us at 097. Well, let me not use this line. Let's just put this other number. You can call us at 0953 979798 or 0973 3333098. This number is on WhatsApp if you want to WhatsApp. So this has been, that's my beautiful name right there. That's my beautiful name, Lusambo Shadrach. That's my beautiful name. And for today, I thought that we could be able to share this. Remember, the important point to remember when you're dealing with goodwill is the accounting treatment of goodwill. What does the standard say about goodwill? Yes. The accounting treatment is very important right there. So if you want to call us right there, that's my, oh, that's Mr. Sambo right there. Oh yeah, that's Mr. Sambo right there. Okay. Thank you so much for watching. And we hope to see you next time in our next session. Remember to share this